Hey everyone, me Kevin here. The Federal Reserve Chairman Jerome Powell is going to be speaking in about 4 minutes time. And what I want to do is I want to just give you a quick overview of everything that we know so far. So we know they're keeping rates stable. We know they're keeping their bond purchases stable. But a few other things have come out. First, I want to talk about some of their projections for GDP, what kind of decline we're going to see next year. And also we're going to talk about what they expect for the unemployment rate and when interest rates will go up, which members think interest rates are going to go up when. Then it's also important to note that the Fed's now talking about keeping their bond buying at the same pace until there has been, quote, substantial progress on inflation. So this is a change in some of the verbiage that they had been using in their previous statement. Obviously, they mentioned the direction of the virus is going to guide all of this, but their projections are really interesting because even though on one hand they're saying, hey, we're going to keep doing our purchases, 40 billion for mortgage-backed securities and 80 on treasuries, take a look at some of these projections they've got here. We've got some really interesting changes over here. So in their last meeting, they projected that GDP would decline at the beginning or for all of 2021 would decline by 3.7%. And now they're expecting a decline of just 2.4%. Now, Jerome Powell is going to be speaking, and we'll go live on that in about 3 minutes. So we're going to take a look at this in just first, and then we'll jump on over to Jerome. But what's fascinating is they're not expecting any of the interest rate projections to change until at least 2024, it looks like here. Because, see, they've got 2023 right here, but they keep the interest rate at basically 0% for the federal funds rate. What we can do, though, is we can also jump over to some of their dot plot projections. Look at this right here. This is their stance on interest rates. And so each member can kind of like pick what they think rates will go to in the future. And so what you'll see is with the Federal Reserve for interest rates, there's only one person at the Federal Reserve who says rates should go up in 2022. Then you've got, 3 people who say rates should go up a little bit, about 0.25% in 2023. Somebody else thinks 0.5% or a little bit more, and then we've got a little bit over 1% of a bump over here. But then it's really just beyond the 2023 territory. This is where every single member in the Fed thinks rates should go up. So realistically, they're not touching rates until 2023, 2024, probably, until they actually start seeing that inflation come in. Now, remember, we are going to see that inflation bump in March through May. But interesting to see that they actually modified their projections on the economy and actually think the market's going to do better going forward than their September projections. Let's take a little bit more of a detailed look at this for another minute here, and then Jerome will be talking. So their GDP projection for 2021, 4.2%. And then, so really actually kind of almost like a boost of GDP here after we get back to normal is what they're expecting. And then going back to a longer run, real GDP, that's inflation adjusted, of about 1.8% above and beyond inflation. The unemployment rate, they think, will go back, look at this, under 5 or at 5% by the end of 2021. That's an improvement as well. The fact that we could see that 5 to 4% unemployment again in 2021. These are actually really good statements for the economy. I wouldn't be surprised if markets react very positively to this. So Jerome Powell is going to be speaking in just a moment. So let's go ahead and switch on over and get ready for Jerome. And we'll see what he has to say. So he starts any minute now. And we'll listen in. I'll add commentary as he speaks, so that way we kind of get an idea as it's happening of what he's thinking. So we'll go ahead and set up here. Pop on over to the Federal Reserve's page. There we go. So this is, they do play music for us. Let's make sure we go to live. Oh, hold on. They messed up their live stream. 1 second. Let me go to the actual live page. I have a separate one. Here it is. Live. It's coming out in a second. There we go. So we're live on the Federal Reserve's page now, just waiting for Jerome Powell, and we'll see what he says. I think he's about 30 seconds delayed on this live stream from actual. There he is. He's always on time.
Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Since the beginning of the pandemic, we've taken forceful actions to provide relief and stability, to ensure that the recovery will be as strong as possible, and to limit lasting damage to the economy. Today, my colleagues on the FOMC and I reaffirmed our strong forward guidance for interest rates and also provided additional guidance for our asset purchases. Together, these measures will ensure that monetary policy will continue to deliver powerful support to the economy until the recovery is complete. Economic activity has continued to recover from its depressed second quarter level. The substantial reopening of the economy led to a rapid rebound in activity, and real GDP rose at an annual rate of 33% in the third quarter. In recent months, however, the pace of improvement has moderated. Household spending on goods, especially durable goods, has been strong and has moved above its pre-pandemic level. In contrast, spending on services remains low, especially in sectors that typically require people to gather closely, including travel and hospitality. The overall rebound in household spending owes in part to federal stimulus payments and expanded unemployment benefits, which provided essential support to many families and individuals. The housing sector has fully recovered from the downturn, supported in part by low mortgage interest rates. Business investment has also picked up. The recovery has progressed more quickly than generally expected, and forecasts from FOMC participants for economic growth this year have been revised up since our September summary of economic projections. Even so, overall economic activity remains well below its level before the pandemic, and the path ahead remains highly uncertain. In the labor market, more than half of the 22 million jobs that were lost in March and April have been regained, as many people were able to return to work. As with overall economic activity, the pace of improvement in the labor market has moderated. Job growth slowed to 245,000 in November, and while the unemployment rate has continued to decline, it remains elevated at 6.7%. Participation in the labor market remains notably below pre-pandemic levels. Although there has been much progress in the labor market since the spring, we will not lose sight of the millions of Americans who remain out of work. Looking ahead, FOMC participants project the unemployment rate to continue to decline. The median projection is 5% at the end of next year and moves below 4% by 2023. The economic downturn has not fallen equally on all Americans, and those least able to shoulder the burden have been the hardest hit. In particular, the high level of joblessness has been especially severe for lower wage workers in the service sector and for African Americans and Hispanics. The economic dislocation has upended many lives and created great uncertainty about the future. The pandemic has also left a significant imprint on inflation. Following large declines in the spring, consumer prices picked up over the summer, but have leveled out more recently. For those sectors that have been most adversely affected by the pandemic, prices remain particularly soft. Overall, on a 12-month basis, inflation remains below our 2% longer-run objective. The median inflation projection from FOMC participants rises from 1.2% this year to 1.8% next year, and reaches 2% in 2023. As we have emphasized throughout the pandemic, the outlook for the economy is extraordinarily uncertain and will depend in large part on the course of the virus. Recent news on vaccines has been very positive. However, significant challenges and uncertainties remain with regard to the timing, production, and distribution of vaccines, as well as their efficacy across different groups. It remains difficult to assess the timing and scope of the economic implications of these developments. The ongoing surge in new COVID-19 cases, both here in the United States and abroad, is particularly concerning, and the next few months are likely to be very challenging. All of us have a role to play in our nation's response to the pandemic.
Like
Following
Congress.
the advice of public health professionals to keep appropriate social distances and to wear masks in public will help get the economy back to full strength. A full economic recovery is unlikely until people are confident that it is safe to re-engage in a broad range of activities. As we previously announced, we are now releasing the entire package of our SEP materials at the same time as our FOMC statement.
Yeah.
Included in these materials are two new exhibits that show how the balance of participants' assessments of uncertainty and risks have evolved over time. Since the onset of the pandemic, nearly all participants continue to judge the level of uncertainty about the economic outlook as elevated. In terms of risks to the outlook, fewer participants see the balance of risks as weighted to the downside than in September. While a little more than half of participants now judge risks to be broadly balanced for economic activity, a similar number continue to see risks weighted to the downside for inflation. The Fed's response to this crisis has been guided by our mandate to promote maximum employment and stable prices for the American people, along with our responsibilities to promote the stability of the financial system. As noted in our statement on longer-run goals and monetary policy strategy, we view maximum employment as a broad-based and inclusive goal. Our ability to achieve maximum employment in the years ahead depends importantly on having longer-term inflation expectations well anchored at 2%. As we reiterated in today's statement, with inflation running persistently below 2%, we will aim to achieve inflation moderately above 2% for some time, so that inflation averages 2% over time and longer-term inflation expectations remain well anchored at 2%. We expect to maintain an accommodative stance of monetary policy until these employment and inflation outcomes are achieved. With regard to interest rates, we continue to expect it will be appropriate to maintain the current 0 to 1/4% target range for the federal funds rate until labor market conditions have reached levels consistent with the committee's assessment of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time. In addition, as we noted in today's policy statement, we will continue to increase our holdings of Treasury securities by at least $80 billion per month and of agency mortgage-backed securities by at least $40 billion per month until substantial further progress has been made toward our maximum employment and price stability goals. We believe the increase in our balance sheet this year has materially eased financial conditions and is providing substantial support to the economy. Combined with our forward guidance for the federal funds rate, our enhanced balance sheet guidance will ensure that the stance of monetary policy remains highly accommodative as the recovery progresses. Our guidance is outcome-based and is tied to progress toward reaching our employment and inflation goals. Thus, if progress toward our goals were to slow, the guidance would convey our intention to increase policy accommodation through a lower expected path of the federal funds rate and a higher expected path of the balance sheet. Overall, our interest rate and balance sheet tools are providing powerful support to the economy and will continue to do so. The Federal Reserve has also been taking broad and forceful actions to more directly support the flow of credit in the economy for households, for businesses large and small, and for state and local governments. Preserving the flow of credit is essential for mitigating damage to the economy and promoting a robust recovery. Many of our programs rely on emergency lending powers that require the support of the Treasury Department and are available only in very unusual circumstances, such as those we find ourselves in today. These programs serve as a backstop to key credit markets and have helped to restore the flow of credit from private lenders through normal channels. We have deployed these lending powers to an unprecedented extent, enabled in large part by financial backing and support from Congress and the Treasury. Although funds from the CARES Act will not be available to support new loans or new purchases of assets after December 31, the Treasury could authorize support for emerging lending facilities if needed through the Exchange Stabilization Fund. When the time comes, after the crisis has passed, we will put these emergency tools back in the box. As I have emphasized before, these are lending powers, not spending powers. The Fed cannot grant money to particular beneficiaries. We can only create programs or facilities with broad-based eligibility to make loans to solvent entities with the expectation that the loans will be repaid. Many borrowers are benefiting from these programs, as is the overall economy. But for many others, getting a loan that may be difficult to repay may not be the answer. In these cases, direct fiscal support may be needed. Elected officials have the power to tax and spend and to make decisions about where we as a society should direct our collective resources. The fiscal policy actions that have been taken thus far have made a critical difference to families, businesses, and communities across the country.
Tell us you want
more.
Even
so, the current economic downturn is the most severe of our lifetimes. It will take a while to get back to the levels of economic activity and employment that prevailed at the beginning of this year. And it may take continued support from both monetary and fiscal policy to achieve that. To conclude, we understand that our actions affect communities, families.
He's going to do Q&A, and this tends to be important.
Everything we do is in service to our public mission. We are committed to using our full range of tools to support the economy and to help assure that the recovery from this difficult period will be as robust as possible. Thank you. I'll look forward to your questions.
All right.
Thank you. Rich Miller.
Thank you very much, Mr. Chairman. Thank you, Michelle. I wonder if I could start with the SEP. We have unemployment now is at 6.7. The SEP median sees it falling to 5. Headline inflation is 1.2. The SEP median sees it rising to 1.8, and core inflation is 1.4, and the SEP sees it rising to 1.8 likewise. Would that constitute substantial further progress toward the committee's maximum employment and price stability goals?
Yes, well, so we're not going to be identifying specific, associating that test with specific numbers at this point. So really, the question is, what do we mean by that language? And really, the overarching message, Rich, is that our guidance for both interest rates and asset purchases will keep monetary policy accommodative until our maximum employment and price stability goals are achieved, and that's a powerful message. So substantial further progress means what it says. It means we'll be looking for employment to be substantially closer to assessments of its maximum level, and inflation to be substantially closer to our 2% longer run goal before we start making adjustments to our purchases.
They really don't see inflation coming for a while. I mean, till 2024, they just don't see it. People buying Bitcoin think it's around the corner.
Come a time when the economy does not require increasing amounts of policy accommodation, and when that time comes, and that will be uncertain, and it's in any case is some ways off.
Some ways off.
So I can't give you an exact set of numbers. We will, of course, as we approach that point, we'll be evaluating that. And
let me just translate that really quick. So the guy's asking, hey, like, can you tell us at exactly what point you're going to raise rates? Like, if we hit 4% unemployment, are you going to raise rates? Jerome Powell saying, look, no, we can't tell you that. And the reason Jerome can't tell that is because they're literally just going to keep rates low until these things happen, and then they'll think about it.
And regarding asset purchases, why not increase the duration of the asset purchases at this time, given what you see as a very challenging period ahead?
That was an expectation.
You know, again, I would start with what we actually did at the meeting, which was we provided this guidance about the path of asset purchases, and I just went through what the guidance that we put forward. And so I guess since September, we've now adopted a flexible average inflation targeting framework. We have provided rate guidance that is tightly linked to the goals as expressed in that new framework, and now we've done the same for asset purchases. So we've been sort of as the future has become clearer, and as we've absorbed new developments in the medical sphere and also in the economy, we have began to be able to see further. So we've started to be able to provide further important guidance, and we think that the asset purchase guidance is very important. We think that the prior language of in coming months was obviously temporary. This links that guidance, those purchases, to actual substantial further progress toward our mandated goals. We think that's important.
Basically, initially they said, we're going to keep printing money for months, but now we're deciding to just keep printing money until there's been substantial progress. And we're going to keep doing it until everybody gets vaccinated and this pandemic's over.
Financial conditions are highly accommodative, and we monitor a range of financial condition indexes. There are many of them, and they'll all pretty much tell you that. You can also look at the interest-sensitive parts of the economy, for example, housing, durable sales, vehicle sales. Those parts of the economy are performing very, very well. The parts of the economy that are weak are the service sector businesses that involve close contact. Those are not being held back by financial conditions, but rather by the spread of the virus. And I'll close by just saying we do have the flexibility to provide more accommodation through the channel you mentioned and through other channels. And we recognize that circumstances could shift in a way that warrants our doing that, including by adjusting purchases. We are committed to using our full range of tools to support the U.S. economy to achieve our goals. We will continue to use our tools to support the economy for as long as it takes until the job.
Keep an eye on that. If, let's say in January, they're like, oh crap, we're going to print a bunch more money, that's a sign that they're getting more nervous, right?
Thank you. Nick Timmeros.
Thank you. Nick Timmeros, the Wall Street Journal. Chair Powell, a two-part question. What, if anything, would prompt the Fed to shift Treasury purchases toward the longer end of the curve, as you did with your prior QE programs? And does your guidance today on asset purchases foreclose the possibility that you could at some point lengthen maturities while simultaneously tapering the monthly purchase amounts?
Well, Nick, on the first part of the question, I wouldn't want to sort of talk about hypothetical situations. You know, we look at our overall stance of policy. We look at overall financial conditions. We look at what's going on in the economy, different parts of the economy, and we ask ourselves, should we change our policy stance? We do that at every meeting, and we look at where financial conditions are now, and we feel that they are appropriate for now. Anytime we feel like the economy could use stronger accommodation, we would be prepared to provide it. But right now we're providing a great deal, and we happen to think it's the right amount. And you mentioned, I think you're referring to the idea of maintaining the duration, but reducing the quantity, which is sort of what the Bank of Canada did. And that is something that we talked about in the last meeting and was addressed in the minutes. And I would say the views on that were mixed. Some thought it was an interesting idea, others not so much. I wouldn't say that that's something that's high on our list of possibilities.
Thank you.
No change.
Thank you. Victoria.
Hi, Victoria Guido with Politico. I wanted to ask about the 13.3 facilities. Chair Powell, you've said that you accept Treasury Secretary Mnuchin's interpretation of the statute of the CARES Act on what should happen with those programs. So first of all, I'm curious whether under a new Treasury Secretary, you will accept whatever legal interpretation they put forward for those programs. And then also, given that there isn't a statutory requirement for you to have financial backing from Treasury for 13.3 facilities, do you have any plans for any future facilities that don't require Treasury backing?
This is in reference to those things
So
that
on your
Treasury
first
took away.
question, we really have not thought about that. We're very focused on. We have a lot to do now, and we have not focused on that question. And I really have nothing to add on that. Your second question is, sorry. No, if there were no. We would have the ability. Certainly, we would have the ability to do facilities under 13.3, in some cases with no backing. But we can't do any 13.3 facilities without the approval of the Treasury Secretary, right? But we did some facilities. I think one of our facilities this time didn't have any Treasury backing, and I think some in the round of during the global financial crisis also didn't have any.
So do you have any plans, like would you consider doing more facilities if that became necessary without Treasury backing?
I would say that we are, we have the authorities we have. We will use them if they're needed, and if the law permits us to do so. We would always do that. We do not have any plans for the future about this. We're very focused on getting through year end. We've been very focused on the issues that are right in front of us, and honestly, we're not.
Basically, this is a follow-up to Treasury Secretary Mnuchin got rid of the loan programs like the Main Street Lending Program, the Municipal Credit Facility, and some others to support basically the flow of credit to car loans, student loans, and so on. But those were not really being used anymore. And so the media seems to be infatuated with getting those programs back. And Jerome's like, we're not even talking about that.
Stimulus program in Congress. Is that sufficient? Is that what you're looking for? If you think that'll be sufficient for helping the economy? Finally, you talked about the idea of how concerning the recent surge is. I wonder if you could put some detail on that. How much concern do you have in terms of where could employment go? What could happen to GDP in the first quarter as a result of this surge? Thank you.
Stimulus question.
Okay, so on fiscal policy, I would just say a couple things. The case for fiscal policy right now is very, very strong, and I think that is widely understood, I would say now. The details of it are entirely up to Congress, but with the expiration of unemployment benefits, some of the unemployment benefits, the expiration of eviction moratoriums, with the virus spreading the way it is, there's a need for households and businesses to have fiscal support. And I do think that, again, I think that is widely understood. So I think it would be, I certainly would welcome the work that Congress is doing right now. It's not up to us to judge that work. It's really theirs. And I don't have a view for you on the size of it. It's it's obviously a substantial bill. On the surge, so it's a really interesting question. We have, and others too, have consistently expected there to be more economic, that cases would hold, growth in cases would hold back the economy more than it actually has. So we've overestimated the effects on the economy of these spikes we've been having. Now, this spike is so much larger that I think forecasters generally do think that that this will have an effect on suppressing activity, particularly activity that involves people getting together in bars and restaurants, on airplanes and hotels and things like that. And you're starting to see that in the high frequency data. You're now beginning to see that show up. And I think this is the case numbers are so high and so widespread across the country that seems like it must happen. Now, how big will it be? We don't really know. There are a lot of estimates. The general expectation is you're seeing some slowing now, and you'll see the first quarter could well be. What we said is that coming months are going to be challenging. The first quarter will certainly show significant effects from this. At the same time, people are getting vaccinated now. They're getting vaccinated, and by the end of the first quarter, into the second quarter, you're going to be seeing significant numbers of people vaccinated. And so then how will that play into economic activity? Again, we don't have any experience with this. You have to think that sometime in the middle of next year, you will see people feeling comfortable going out and engaging in a broader range of activities. And some people will be probably quick to do that. Some are doing it now without a vaccine, right? In many parts of the country. So nonetheless, my expectation, and I think many people have the expectation, that the second half of next year the economy should be performing strongly. We should be, we should be getting people back to work. Businesses should be reopening and that kind of thing. The issue is more the next 4 or 5 months, getting through the next 4, 5, 6 months. That is key. And clearly there's going to be need for help there. And my sense and hope is that we'll be getting that.
Wow. Okay. So seeing that mobility data go down, expecting that vaccine to basically take effect in the second half of next year. And that's when we should start seeing data come back up. But that for the next 4 to 6 months, we could see slow. And he encourages the stimulus package.
You were mentioned in the most recent minutes as, potentially a valuation concern, especially as it related to your mortgage-backed security purchases. And you mentioned earlier today that the housing market looks more or less fully healed. And so I guess I wonder, are you worried about valuation pressures there? And if so, what can the Fed do to contain those?
Real estate crash.
We monitor basically just about every asset price in the economy, and housing prices are something that we've been monitoring, and you see them moving up. You see very high demand. This is the housing market that people have been expecting since 2010, and then not many when the pandemic hit thought, oh, this is what will produce that housing market, but it has. Now, I would say from a financial stability standpoint, housing prices are not of a level of concern right now. That's just reflective of a lot of demand, and builders are going to bring forth supply. There's also a sense that some of this may be pent up demand from when the economy was closed, which would imply that demand, once that demand is met, that the real level of demand will be more manageable. So it's a healthy economy now. We met recently with a bunch of home builders, and many of them in the business 30, 40 years, so they'd never seen the likes of it. But no, housing prices themselves are not a financial stability concern at the moment.
Wow.
We will watch that carefully, but in the near term, I wouldn't think that that's an issue that we'd be concerned about.
That's a big statement. He said no, basically.
Thank
no
you,
crash,
Edward Lawrence.
Thank you for the question. Mr. Chairman. So, with the actions that you've currently taken, how do you further fight a slowdown that you're seeing? We talked about the retail sales numbers are a little bit sluggish this month. The unemployment, the job growth has slowed down. Is there more the Fed can do to fight this, or is it now squarely in the Congress's realm?
There is more that we can do. Certainly, we can expand our asset purchase programs. We can focus them more on the longer end. There are a number of options we would have to provide more support to the economy. I would say, though, that in the near term, the help that people need isn't just from low interest rates that stimulates demand over time and works with long and variable lags. It's really support. As we've talked about this as
stimulus.
All of these government policies trying to work together to create a bridge across this chasm, economic chasm that was created by the pandemic. And for many Americans, that bridge is there, and they're across it. But there's a group for which they don't have a bridge yet, and that's who we're talking about here. It's the 10 million people who lost their jobs. It's people who may lose their homes. It's you see the many millions of Americans are waiting in food lines in their cars these days all over the country. So we know there's need out there. We know there are small businesses all over the country that have been basically unable to really function, and they're just hanging on. So, and they're so critical to our economy. So, and by the way, now that we can kind of see the light at the end of the tunnel, it would be bad to see people losing their business, their life's work in many cases, or even generations worth of work because they couldn't last another few months, which is what it amounts to. So we have more we can do. And I think more the issue is we're going to need to continue to provide support to this economy for quite a period of time, because the economy will be growing in expectation, should be growing at a fairly healthy clip by the second half of next year. But it's going to be a while before we really are back to the levels of labor market, the sort of conditions in the labor market that we had in early this year and for much of the last couple of years. So that's how I think about it.
Wow.
Thank you.
Wow. Statements here.
Thank you. Howard Schneider.
Hi, Chair Powell. Thanks for doing this. And thanks, Michelle. Two quick questions. One, on the vaccine, do you have, or has the Fed modeled sort of a working estimate of when the U.S. might reach something approaching herd immunity? And secondly, if you could please connect with me the lack of movement on the decision to maintain the current pace and quantities of bond purchases with the fact that the steps are showing 3 years with inflation not reaching 2%.
AKA, why are you not printing more money now?
To start fixing those expectations and to let this drift and say, we're going to miss our target for another 3 years, doesn't show a very firm commitment to the new framework.
Wow.
So in terms of the vaccine, yeah, we do estimates, but of when the United States would reach herd immunity, and they're going to be similar to what other people think. It depends on your assumptions, such as how many people will actually take the vaccine, and how fast will the rollout be. So it's assumption based on assumption based on assumption. But sometime it's possible sometime in the middle or second half of next year. I'm not going to try to be precise because it's just another estimate. Our people are very good, but they're looking at the same data as other people are, so all the estimates are. It depends on what your assumptions are, but under a normal set of assumptions, it could happen as soon as the middle of next year. In terms of the inflation, there are a couple things. Your second question, I think you have to be honest with yourself about inflation these days. There are significant disinflationary pressures around the world, and there have been for a while, and they persist today. It's not going to be easy to have inflation move up, and it isn't going to be just a question. It's going to take some time. It took a long time to get inflation back to 2% in the last crisis, and we're honest with ourselves and with you in the SEP that even with the very high level of accommodation that we're providing both through low rates and very high levels of asset purchases, it will take some time, because that's what we believe the underlying inflation dynamics are in our economy. And that's sort of one reason why we're concerned about inflation, is that we see that, and that's why we have adopted the flexible average inflation targeting framework. That's why we're aiming for an overshoot, but we're honest with ourselves and with the public that it will take some time to get there. In terms of, would it really speed it up a lot to move asset purchases? I don't think that would really be. I think it's going to take a long time however you do it. And, we've been having very long expansions since in the last several decades because inflation has not, the old model was inflation would come along and the Fed would tighten and we'd have a recession. Now inflation has been low and we haven't had that dynamic. And the result has been 3 of the 4 longest expansions in modern history, in recorded history. So, we're thinking this could be another long expansion, and that will keep what we're saying is we're going to keep policy highly accommodative until the expansion is well down the tracks, and we're not going to preemptively raise rates until we see inflation actually reaching 2% and being on track to exceed 2%. That's a very strong commitment, and we think that's the right place to be.
Gosh, he's basically saying we see so little inflation happening that even if we printed more money, it wouldn't make a difference. That's crazy.
Markets have actually found this fairly credible. If you look at inflation compensation and at the survey measures of when the Fed will lift off, everything has moved. There have been significant movements since we announced the framework in the direction that is consistent with the framework being credible to market participants. So I don't think it's something that I'm actually pleased by the reception it's gotten in markets, and markets have moved in ways that suggest it is credible.
These are big statements here.
Thank you, Chris.
Hi, thank you. Yesterday, I guess the Fed said that it's joining the International Financial Greening Group, and I just wanted to see if you could expand on how the Fed is thinking about climate change and how it might affect Fed policy going forward. Specifically, I think Janet Yellen drew a distinction between considering climate change when it came to financial regulation. But how do you see that also potentially affecting monetary policy? Obviously, there have been criticisms of the Fed for buying bonds of oil and gas companies. But leaving that specific case aside, is there any way that climate change considerations could affect monetary policy going forward?
So you're talking about the Network for Greening the Financial System, which we joined this week, and I'll just say a couple things about that. So first, I'll just start by saying that we're going to move carefully and thoughtfully on developing an understanding of how climate change affects our work, including the areas you mentioned. We're going to do so with a great deal of engagement with all of our external constituencies, including the public and their elected representatives who are charged with our oversight. We'll do it with great transparency. Remember that we are a non-political agency whose goals and authorities to achieve those goals are set by Congress. We have great responsibilities and strong authorities that we'll use vigorously. We're not the forum where all the great issues of the day are to be hashed out, debated, and addressed, unless and only to the extent that those issues are directly relevant to our statutory goals and are addressable through our legal authorities. And because we have a narrow remit and because we stick to it, Congress has given us a precious grant of independence from direct political control. So society's broad response to climate change is for others to decide, in particular elected leaders. But so let me get to your question. What does all that mean for an issue like climate change? And why did we join the NGFS? So Congress hasn't explicitly assigned us or other financial regulators a role, and we're not among the agencies who contribute to the National Climate Assessment, for example. But climate change is nonetheless relevant to our existing mandates under the law, and let me tell you why. One of our jobs is to regulate and supervise banks and to look after the stability of the financial system. That's a responsibility we share with other agencies. The public will expect that we will do that. So we'll expect that those important institutions will be resilient against the many risks that they face: credit risk, market risk, cyber risk. Climate change is an emerging risk to financial institutions, the financial system, and the economy. And we are, as so many others are, in the very early stages of understanding what that means, what needs to be done about it, and by whom. That's why 83 central banks have joined together to share research and identify best practices in this important emerging area. We've been attending NGFS meetings as an observer for more than a year, taking part in the work. We had discussed that it was probably time to join as a member. I'll just say that the financial system is really a global one. It's important that we work and discuss best practices with peer agencies around the world, especially in a field where we're just beginning to develop our understanding. You ask about monetary policy. I'll say this: we have historically shied away strongly from taking a role in credit allocation. In fact, our agreement with Treasury during the financial crisis from back in 2009 or 10 says that we will avoid credit allocation. It's something we've carefully avoided. So I would be very reluctant to see us move in that direction, picking one area as creditworthy and another not. So you asked about monetary policy. It's for now, I would say the real concern is the real place to focus for me is supervision of financial institutions and then financial stability concerns. You can see a connection there. Monetary policy, maximum employment, stable prices. It's less obvious to me. I can make the argument, but it's less obvious to me that those should be first order things that we would look at in connection with climate change. But I think there's work to be done to understand the connection between climate change and the strength and resilience of financial markets and financial institutions. I think that work is in its early days. And again, we'll be careful, we'll be thorough and transparent and engage with the public on all that.
Wow.
Thank you.
A lot of good things to talk about.
Thank you. Rachel Siegel.
It's all good.
Hi, Chair Powell. Thanks very much for taking my question. And thank you, Michelle. I wanted to ask specifically about state and local aid. Just as one example, the governor of Illinois announced roughly $700 million in early anticipated budget cuts to close a budget deficit. And the latest bipartisan stimulus proposal that's being debated this week seems to be leaving out state and local aid at this point. And I'm just curious if you can give some detail about the damage that these budget deficits or the lack of aid specifically to state and local governments will have on the recovery, and specifically with the municipal lending facility set to expire, what more the Fed might be able to do to fill that specific hole. Thanks very much.
Okay, so the state and local governments, they provide important critical services: safety, fire, police, health, all kinds of things like that. They're really involved in people's lives. State and local governments are to a large extent. The decision whether to provide more fiscal support to them is entirely in the hands of Congress. And they're in the middle of these discussions, and those are issues for them to decide. I would say that the picture is mixed. What's happened is, if you're a state that has a significant exposure to tourism or to extracting energy from the ground, oil from the ground, or gas, you are probably, at least in those industries, feeling a significant loss of revenue. A number of other states have been surprised on the upside, and that's because goods sales, for example, property taxes don't move much year to year, and the kind of sales taxes on goods sales have been very high. Income has been more or less replaced by the CARES Act, fully replaced, more than in many cases. So the concerns that we had at the very beginning of really serious, deep shortfalls and massive budget cuts on the part of state and local governments have not yet occurred. What we're seeing is that it's different state to state, and some states are having significant difficulties, others not so much. The real concern, though, that still emerges is state and local governments are very large employers, and one of the largest. And so far, since the pandemic began, employment has dropped by 1.3 million of state and local. So it's a very large number of people to be out of work from just that one source. It's actually significantly more than lost their jobs during the global financial crisis. So wow. that is a significant part of that group is in education. So when the schools reopen, a significant part of that 1.3 million would go back to work. Nonetheless, it's a concern. We're watching carefully to understand why that many people have been let go and what really are the sources. So we're monitoring it carefully, and it's a mixed picture. And I just have to leave the question of what to do with fiscal policy on this to Congress.
Thank you. James Politi.
So one thing I will say really quick while I ask the next question is it sounds like he's suggesting, hey, you know what, we're not really seeing the massive issues of the layoffs yet at states. Yeah, we've had 1.3 million jobs lost, but many of those jobs are coming back when schools reopen. But he does say, hey, you know what, on Congress to add more aid. Obviously, it'd be nice to see that.
Where there's so much suffering in the economy. The guidance today sort of cements asset purchases for a longer period of time, but is not a big new easing step. Why was now, with the short-term outlook deteriorating due to the new coronavirus surges, not the moment for a big new easing step? And is it because of the medium-term outlook improving, or is it because the Fed just doesn't have the capacity to sort of build that bridge over the next 4 to 5 months for the people who are struggling?
Right. So I could go back, James, to what I said earlier, which is this is a very, very large asset purchase program. It's providing a tremendous amount of support for the economy. If you look at the interest-sensitive parts of the economy, they're performing very well. The parts that are not performing well are not struggling from high interest rates. They're struggling from exposure to COVID. In a sense, these are the businesses where that are really hit hard by people's reluctance to gather closely. So we do have the ability to to buy more bonds or to buy longer term bonds, and we may use it. I'm not saying we won't use it. It may well come to using that, but also I would also note, though, monetary policy works with long and variable lags, is the famous statement. So we think that the big effects from monetary policy are, months and months into the future. So this looks like it looks like a time when what is really needed is fiscal policy, and that's why it is a very positive thing that we're getting that. So we remain open to doing to either increasing the size of our asset purchases, if that turns out to be appropriate, or to just moving the maturities, moving to buying longer maturities, because that also increases accommodation by taking more duration risk out of the market. But we think our current stance is appropriate, and we think that our guidance on asset purchases today will also provide support to the economy over time. Again, what we've done is we've laid out a path whereby we're going to keep monetary policy highly accommodative for a long time, really until we reach very close to our goals, which is not really the way it's been done in the past. So that's providing significant support for the economy now. We don't think the economy suffers from a lack of highly accommodative financial conditions. We think it's suffering from the pandemic and people wanting to not engage in certain kinds of economic activity. And we expect that with the virus that will improve. That condition will improve. Nonetheless, again, we are prepared to use our tools. We will use them at such time and in such amounts as we think would help.
What's really interesting about what he just said is that his actions affect the market months and months in the future. That fiscal works right away, like Congress stuff works right away. So the impact of all this money printing is still to be seen, basically, is what he's saying.
Demand for travel and entertainment and services and the like that might stop being pent up in a hurry if we do get to a point where the vaccine is widely distributed, and that the beaten down service sector might have trouble meeting that demand in a hurry. How might that affect inflation in your mind? And would that be just a transient problem or something that might warrant closer scrutiny?
So that has all the markings of a transient increase in the price level. So you can imagine that as people really want to travel again, let's say, that airfares go, I'm just imagining this, right? That they go up. But what inflation is a process whereby they go up year upon year upon year upon year. And if given the inflation dynamics that we've had over the last several decades, just a single sort of price level increase has not resulted in ongoing price level increases. And that was the problem back in the 1970s. It was the combination of two things. One, when unemployment went down and resources got tight, prices started going up. But the second problem was that increase was persistent. There was a level of persistence. So if prices went up 6% this year, they'd go up 6% next year because people would internalize. I mean, really, that's what happens is people internalize that they can raise prices and that it's okay to pay prices that are going up at that rate. So that was the inflation. Those were the inflation dynamics of that era. Those dynamics are not in place anymore. The connection between low unemployment or other resource utilization and inflation is so much weaker than it was. It's still there, but it's a faint heartbeat compared to what it was. And the persistence of inflation, if you get for example, oil prices go up, and that'll send a temporary shock through the economy. The persistence of that into inflation over time is just not there. So that what you described may happen, and of course we would watch it very carefully. We understand that we will always be learning new things from the economy about how it will behave in certain cases. But I would expect, though, going in that would be a one-time price increase rather than an increase in underlying inflation that would be persistent.
So really interesting here how he's comparing to the 70s, saying, look, because we have such low inflation now, we really expect inflation to stay low. It's so different from the 70s where you'd have 6% inflation and then people are like, okay, well, I'll raise my prices 6% and I'll do it again next year, you know?
Question, but what I wanted to ask was, given the size of government borrowing and, different regulatory changes in the financial sector, do you think that the Treasury market long run can operate smoothly without some sort of active Fed presence, buying Treasury debt? I'm referring back to one of those Randall Quarles. He had some questions about that. So I wanted to know where you stood on that issue.
Right. So you were breaking up a little. I think I got the sense of it, though.
Okay.
Yeah, I don't think it's at all a foregone conclusion that there needs to be a permanent Fed presence, and we certainly don't. That's not something we're planning on or intending. Right now, we're buying assets because it's a time when the economy needs highly accommodative monetary policy, and we think our asset purchases are one of the main delivery mechanisms for that. This is the size of the balance sheet. There's lots of demand for U.S. Treasury paper from all over the world. And I think we need to be thoughtful about the structure of the Treasury market and look at ways to make sure that the capacity is there for it to be handled by the private sector. And there's quite a lot of work going on that front. But I don't presume at all that this is something that needs to be where the Fed needs to be in there at all. I would think that this should be handled by the private sector and can be. Institutions need to be able to hold this paper, and there may be a central clearing angle that would net a lot of risk. That's yet to be proven. There are a lot of things that are being looked at right now.
Thank you. Hannah Lang.
Hi. Thanks so much for taking our questions. So, as you know, the pandemic has really disproportionately impacted small and medium-sized businesses, and the Fed launched a few efforts this year through its 13.3 programs to reach out to those companies. But, considering that some of those programs are ending, is there anything else that the Fed's actions can do to provide support to those companies, or is that solely Congress's domain?
I think the main thing that those companies need is a robust recovery, a strong, robust recovery. And so we contribute to that through highly accommodative monetary policy, through accommodative financial conditions that are supporting economic activity. Health authorities are contributing to that through management of the spread of the virus, and now through vaccines and the delivery of those vaccines. And Congress contributes to that by helping them make it through this very difficult time. And I think my understanding is that there's support for small businesses in what's being discussed on Capitol Hill. I would certainly think that would be something well worth looking at.
Thank you. Paul LaMonica.
Hi, Chair Powell. I was wondering if you've had any conversations yet with any members of the incoming Biden administration, particularly Janet Yellen, who obviously you can share some similar experience in running the Fed. So just curious to get your thoughts on how the relationship with Treasury and the new administration might differ than the past couple of years?
So, we've had and I've had sort of the typical meetings with the transition team for Treasury. They've met with quite a lot of people at our agency and other agencies, and really it's about learning what we do. I really have only spoken to former Chair Yellen to congratulate her on being nominated, and just to say that I look forward to working with her. I did work very closely with her for 5 years before she left, and have stayed in touch. So I did that, but I have not discussed policy with her, and I'm not going to do that until she's confirmed.
Great, thank you. Jeff Cox.
Yes, Chair, thank you for taking the question. You've been asked this question before in various forums. I'm going to try it a little bit differently now. The equity market and the bond market seem to be telling two different stories about where things are heading. We continue this on the stock market. Bond yields remain very low. Does that concern you at all? And are you getting any more concerned about asset value?
It's basically asking, why are stocks awesome and why do bonds suck? But we already knew that.
You were breaking up, but I think I got that. I think I got it. So, financial stability. We look at a broad range of things. We actually have a framework so that we can, evaluate changes in financial stability over time, and so that the public can evaluate whether we're doing a good job at it. So what do we look at? Asset prices is one thing that we look at. And, we published a report a few weeks ago on that. Maybe it was a month or so ago. Anyway. And I think you'll find a mixed bag there. It depends with equities. It depends on whether you're looking at PEs or whether you're looking at the premium over the risk-free return. If you look at PEs, they're historically high, but in a world where the risk-free rate is going to be low for a sustained period, the equity premium, which is really the reward you get for taking equity risk, would be what you'd look at, and that's not at incredibly low levels. So, which would mean that they're not overpriced in that sense. Admittedly, PEs are high, but that's maybe not as relevant in a world where we think the 10-year Treasury is going to be lower than it's been historically from a return perspective. We look at we also look at borrowing leverage of financial institutions. We spent 10 years, and the banks spent 10 years building up their capital. So far, they've been a source of strength through this crisis, and their capital has held up well. We look at leverage in the non-financial sector. That's households and non-financial corporates. Non-financial corporate leverage is high. We've been watching that, but rates are really low. So companies have been able to handle their debt loads even in weak periods because rates are quite low. Your interest payments are low. Defaults and downgrades have declined since earlier in the year. Households came into this very strong, and there certainly has been a hit there for people who are unemployed. But with the CARES Act, Congress replaced a lot of lost income. It's very important that the economy gets strong again. I mean, the ultimate thing to support financial stability is a strong economy. The last thing is really funding markets. We found that there was a lot of unstable funding for companies, particularly financial companies, and that's down to a very low level these days. So the broad financial stability picture is kind of mixed, I would say. I would say it's, asset prices are a little high in that metric, in my view, but overall you have a mixed picture. You don't have, a lot of red flags on that. So, and it's something that we monitor essentially ongoing, almost daily. We're monitoring these prices for that, and have published our framework, and we'll be held accountable for what we saw and what we missed. So we work very hard at it.
That's a big statement here. Basically,
thank you. And for the last
flags of a market crash coming. Instead, a lot of stability they see, and they're not even worried about high levels of debt.
For the economy, this year's budget deficit is $3.1 trillion, and Republicans have argued they don't want to spend more because we can't afford it. So I'm wondering if you can make the case for how much we can afford. At what point do deficits and the debt start to have an impact on the economy or on interest rates?
And how would we know when we get there?
So people who run for elected office and win, they're the ones, the reward is they get to make those very difficult decisions. And, so we're not charged with providing fiscal advice to Congress. But I would just say as a general rule, it is important to be on a sustainable fiscal path. For my way of thinking and many others, the time to focus on that is when the economy is strong and when unemployment is low and taxes are pouring in, and there's room to get on a sustainable path because the economy is really doing well. You're still now in the some part of an economic crisis, and the fact that Congress is debating a fairly large bill today suggests that something fairly substantial is going to get done. We hope, but what's being discussed is of some size. In terms of what is a sustainable level, I think it's the question is, we've always looked at debt to GDP, and we're very high by that measure. By some other measures, we're actually not that high. In particular, you can look at the real interest rate payments, the amount of what does it cost. And from that standpoint, if you sort of take real interest costs of the federal deficit and divide that by GDP, we're actually on a more sustainable fiscal path if you look at it through those eyes. Again, these are issues for Congress, but I'll just say in the near term, I think the case for fiscal is strong, and I think it would be very good for the economy if we did get something soon.
Well, an argument for continuing to spend is that low interest rates make it affordable. Do you worry you get into a situation where you would have congressional interference in monetary policy making, or at least feel significant political pressure to keep rates low because the country can't afford to pay a significant interest bill?
Yeah, I think we're a very, very long way from that. The Congress has given the Fed independence on the condition that we stick to our knitting. We try very hard to do that. I think that's what people call fiscal dominance. And I think we're just a very, very long way from that. I think, if we do our jobs well and support the economy and achieve maximum employment and stable prices, keep the financial system stable, I don't think that is something that I would worry about, certainly not in the near term.
Thank you very much.
Thank you.
Good afternoon.
Wow. Okay, let's recap this. There's so much here. Wow. Okay. So let's go through the recap here. I'm going to start this off like a normal video. All right, turn that off. Good. Wow. Hold on one sec. Let's go through the recap here because there's so much that happened here. Okay, so 1 second here. Let me okay, here we go. I was not expecting him to end it so fast, though. He just all of a sudden ended it. Okay, let's do the recap. Hey everyone, me Kevin here. The Federal Reserve just spoke in detail about the future of the economy, and they had some pretty big and bold things to say about not just stimulus, but also about the market going forward. Stocks, real estate, all mentioned here. We started out by listening to Jerome Powell mention that the housing sector has fully recovered. I thought that was odd because I never really saw the housing sector fall. We'll hear more about the future of the housing market crash potential in just a moment, though. We heard him start off with saying, look, we're recovering more quickly than expected. The pace of the recovery has moderated, but overall the economy improved way faster than we expected. The Federal Reserve anticipates that unemployment will be 5% at the end of 2021. There are zero inflation projections that indicate the Fed actually thinks inflation will be sustained up until realistically 2023 to 2024. In fact, we can look up their, this looks a little complicated, but we can look at their sheet here. The projections that we have in 2023 is that we'll have in 2023 an unemployment rate of 3.7%. Inflation of 2% in 2023, but nothing higher than that in 2023 or in the long run. Just really not seeing inflation. And this was a big part of his conversation. In addition to not seeing the interest rates at the Fed going up until basically after 2023. Let's move on now to some of the other things that Jerome Powell said, especially regarding the market and stimulus. So regarding the market, he mentioned that obviously in the short term, we expect that the next coming months will be very challenging, was his verbiage, that mobility data is slowing down and the next 4 to 6 months are a big problem. He says the case for stimulus is very, very strong, that the expiration of unemployment payments, the eviction moratorium expiration is a very important case. And it shows that and we know that there is a need for households and businesses to have this fiscal support and stimulus. More on stimulus coming up. I'm just going in the order of his press conference here. First quarter, he says, the first quarter of 2021 will show significant effects of the drags on our economy. And he is then asked, how bad can this get? And he responds to this and says he's not entirely sure how bad things can get, but he says if things worsen, he and the Federal Reserve Board are prepared to introduce more monetary support to the economy, basically printing more money. When he's asked about housing prices, and this was very important here. When asked about housing prices being so high and about housing prices being a concern, he says no. Housing prices are not a factor of concern. This is pent-up demand because of the shutdown and because rates are low. And he says that real levels of demand will be more manageable going forward, but that home builders the Federal Reserve has been talking to say that this is unlike anything they have seen in 30 to 40 years. And Jerome Powell ends the housing market portion by saying that housing prices themselves are not a financial stability concern. AKA, this is a huge slap by the Federal Reserve at any market crash enthusiast hoping for a market crash so they can buy real estate inexpensively. Obviously, you know, what my opinion is on this, we'll maybe talk about it in a different video, but the Jerome Powell, the Federal Reserve, is saying housing prices are not a concern. Rates are low, demand is high, pent-up demand is here. This is expected, basically. And that, in essence, the Federal Reserve sees no real estate crash coming. Certainly assuming we get some sort of rental relief. And I'm injecting this, right? I'm assuming he's expecting the stimulus package to pass so that we get the rental relief and we don't see an eviction crisis. And I mean, I kind of have to agree with that. If we take the eviction crisis part out, maybe we don't see a catalyst for a real estate market crash. Then he says we can do more. We can purchase, we can expand asset purchases. So basically we can print more money. He also says we can focus on longer run asset purchases to create more stability for the long run for the market. He also, and these are changes that they might make if situations worsen in the future. He says, but the help people need is stimulus. People need stimulus. Households need support. But obviously the Federal Reserve can only lend. They cannot spend. This is something he's reiterated many times before, and he made it very clear in this press conference today that they want to see more support for households and individuals. He says that herd immunity is expected, and this is his estimation. He made it very clear that this is just their guess. They're the Fed. They're not doctors, right? They expect herd immunity to come as early as the middle of next year, but they do believe it'll come in the second half of next year. On inflation, this was like fascinating. Okay, so, and this is really important because it has these long run implications for interest rates and everything. So on inflation, he says, we face significant disinflationary pressures. And this is common when you have an economy that matures, you tend to get less inflation over time. When you have technology, you tend to get less inflation over time. He says regarding inflation, it's not going to be easy to get to 2% inflation again. He thinks it's going to take a long time to get to 2% inflation. I mean, and this reiterates what he says in their projection sheet, because look, if we go to their projection sheet, they don't tell us, realistically when they think they're going to get above that 2% target. They say we want to target 2%, but they also, to average out inflation being higher than 2%, we got to shoot higher than 2% for a few years. They don't even chart that, a higher than 2% inflation. So he sees a lot of headwinds to actually getting inflation up, which is weird because at the same time, you got Bitcoin skyrocketing because a lot of people think inflation is coming and it's here to stay, that inflation is going to be a big issue, especially when talk of these stimulus checks coming up, came out last night. We saw Bitcoin rally today. In fact, Bitcoin right now, it's still rallying. Bitcoin right now, look at this here on screen now. You're going to see Bitcoin. I get the notifications out of here. It's at $20,841. It's up 7% today. Had a little bit of a dip here, but rallying again on these stimulus talks. People believe that these stimulus talks are going to usher in a lot of inflation. The Fed doesn't see it. In fact, the Fed said when he was asked, hey, like, can't we just like have inflation faster if we just print more money? And he says, we have to be honest with ourselves and we have to be honest with the public. Even with higher levels of asset purchases, it'll take some time. And we see that trend. We see the disinflationary trend holding us down. He says we have to be honest with ourselves. It's going to take time to get inflation to come. You look at the Bitcoin charts and it's like inflation's going to be here tomorrow. Like sell everything, hide your kids, hide your wife, put all your money over into Bitcoin. You look at the Federal Reserve, they're the polar freaking opposite. They're like, we're printing a lot and we're not seeing inflation. Even if we printed faster, I don't think we'd see inflation right now. That is a huge statement. He says, then, oh my gosh, this was so big too. So then he talks about what about the market going forward, like the future of the market. And this is where he said, I mean, you've got to get 4 free stocks with Webull. No, obviously. But do get 4 free stocks with Webull and deposit $100 to get those 4 free stocks and get your life insurance in as little as 5 minutes. But anyway, he says regarding market expansions, we've in the past, we used to have these short cycles. It was like, okay, you'd grow for 3 or 4 years and then you'd have a recession for 2 and then you'd grow and then you'd have a recession. And anytime inflation would go up, the Fed would raise rates and that would usher in a recession, right? That kind of short-term teeter-tottering hasn't been happening anymore. Instead, Jerome Powell here says, with inflation so low, we have this new dynamic of basically long-run expansions. And he says that this right now could be the start of another long expansion, and they plan to be accommodative to make that happen. They want a long expansion. A long expansion is good for the Federal Reserve. And I see this question here from Frank in the live chat here. November retail report. Yes, the November retail report was substantially down. Retail contracted 1.1%. And this actually aligns with what the Federal Reserve says. The Fed says, look, the next few months are going to be very difficult. This is why we need stimulus. He also said something I haven't heard him say before. He probably has said it before, but I haven't heard him say this before. And this relates to stimulus. He says, look, monetary policy, us money printing, takes time because it's trickle down money, right? You buy a treasury bond, a corporation has more cash. It takes time for them to raise more people and for that money to circulate. So when they're printing money, they're being accommodative for the next 6 months out. So what the Fed was doing 6 months ago is really affecting us today. Whereas the Fed says, look, if we need an immediate injection, the only people who could do that is Congress, and Congress needs to provide more stimulus. He also said, when he was asked about state and local government funding, he said that state and local government funding, my estimation of what I gathered from him is, I actually think he doesn't think state and local government funding is as important as small business support is important. He did say he wants to see more PPP funding, that he's supportive of this. He did say that he wants more household stimulus, that he's supportive of this. But he, on state and local, he said, look, we've already lost 1.3 million state and local jobs, and that's really bad. It's much more than the job loss we had during the great financial crisis. And this is bad because state and local governments are very large employers, and we don't want to see massive more layoffs here. But he says that education is actually a big part of these layoffs. And a lot of these people will go back to schools and back to work when the economy starts opening up again. So this was really interesting that he kind of took the back seat on state and local and said the priority more is households and unemployed. Fascinating. Then he says he's going to, and the board will remain open to more asset purchases. So if they need to, if things just go bad over the next few months like they kind of expect, yeah, they are willing to increase the size of their monetary stimulus. Federal Reserve Chairman Jerome Powell also said that there's this interesting dynamic on inflation. And I know I'm kind of switching between topics here. I'm just going in the order that he was asked questions here. He said there's this interesting dynamic when it comes to inflation. And this has to do with expectations of inflation. And then I'm going to talk about the stock market, which that was crazy too. But so when it came to the expectations of inflation, he says, when you expect 6% inflation as a business owner, and I'm paraphrasing a bit here, you raise your prices 6%. And then you think, okay, well, prices will probably go up again 6% next year. And then you raise your prices again 6%. Right now, with us having basically 1% inflation or next to no inflation, people's expectations are that there ain't no inflation. Now, obviously, that's different if you look at the Bitcoin chart. I mean, you just look at Bitcoin over the last year, and I mean, it's just to the moon. I mean, Tesla's done better, but Bitcoin, not bad. Not some bad growth here, right? And a lot of this Bitcoin move is fear for inflation. That's why we see a lot of this move of money into Bitcoin as more stimulus talks progress. But he mentions that inflation dynamics are just very, very low right now. He also says the link between employment and inflation is barely there anymore. He called it a faint heartbeat. Then, okay, like the amount of gold he gave us today was insane. Then he talked about PE ratios, which every freaking YouTuber who wants to talk about the market crash goes, look at the Shiller PE ratio. Look at the S&P 500 historical PE ratio. All the price to earnings are so high. And I've made many counter videos to these. I just want to tell you right now what Federal Reserve Chairman Jerome Powell says. He says on PE ratios, yeah, they're historically high. But when the risk-free rate, aka the rate on like the 10-year treasury bond, which is like under 1%. Anyway, when the risk-free rate is so low and it's expected to be low for a sustained period of time going forward, it's not unreasonable for you to have high PEs. It makes sense. Now, I'm going to break from what he's saying for a moment and just interject what I think. Usually you have hedge funds that balance bonds and stocks, right? But because bonds have such low yields right now, a lot of hedge funds are staying much more heavily exposed to stocks instead of bonds. That drives up PE ratios. When 25% of the money that's in circulation right now in the world was created in 2020, of course PE ratios are going to go up because people have more cash and they've got to park that somewhere. So going back to what he says, yes, they're high, but they're not as relevant with low rates as to where rates are now. He says that we're looking at leverage at financial institutions, aka banks, and so far, bank leverage has actually been very strong. When it comes to non-banks, corporate leverage is very high, and this is where you get a lot of people going, "Oh my gosh, look at the debt at corporations; it's so high." But Jerome Powell's going, "Yeah, but their actual burden to pay the interest on this debt is so freaking low because interest rates are so low, and that defaults." And downgrades, like credit downgrades, are actually very low right now. We're not seeing a lot of those. He says more important is households, which went into the pandemic very strong, but they got hit hard with unemployment. And so again, why we want to see stimulus for households. On sort of a zooming out picture, he says regarding financial stability, that we have a mixed picture right now because yes, asset prices are high. Yeah, it makes sense that real estate prices are high and stock prices are high because of the amount of money that's in circulation and because of low rates, the low risk-free return of treasury bonds. But he goes on to say, we're not seeing a lot of red flags. He says we monitor red flags daily and they're not seeing a lot of them. In fact, then he gets asked about the US government debt, and he says, look, if you do a chart of debt to GDP, we're at very high levels. But if you do a chart of what it actually costs for us to service our debt, and you divide the cost of our debt by our GDP, we're actually on a much more sustainable path, were his words. So these are like huge statements by the Fed today. I mean, this was probably the most entertaining Fed meeting I've ever watched because he basically just slammed the market crash bears on stocks, slammed the housing market crash bears. He basically slammed that, look, even if we printed more money, we're not going to see inflation, which is what's going to happen with the stimulus check. So he's kind of also slamming Bitcoin. Like Federal Reserve Jerome Powell, I mean, he woke up this morning and he's like, I'm fighting today. I'm pissed at everyone. And he's like, the market's fine. Now, take it for what it is. There are many people who don't believe a word this guy says. But keep in mind, the Federal Reserve is an institution with like 2,000 economists. They do some incredible research. I'm inclined to agree with a lot of what he says. I certainly have my concerns and reservations. But I am investing heavily in the stock market. I'm investing heavily in the real estate market. So my actions certainly align with what the Federal Reserve is indicating here. So very, very fascinating. This entire Federal Reserve meeting was by far the most interesting that I have seen ever. So there you have the complete summary of what happened. Check out the amazing programs linked down below so you can learn my ways of building your wealth in stocks and real estate, and join me in those private live streams every morning when the market is open. So check those out. Links down below. Email me if you want a bundle coupon code at kevin@meetkevin.com. Shout out to Jeff Weibo. Go check out his channel. I was watching his Instagram yesterday you guys were playing that song about going residential or commercial or the hotel versus residential. It was good. Jeff Weibo's got a good channel on YouTube too for real estate. Thanks everyone for being here, folks. We will see you next time.